He was a guest on the podcast back in October, and he predicted higher unemployment, a recession, and lower interest rates. And guess what? He was right. What's next? Well, let's ask him, starting right after the music.
This is Debt Free in 30. Here's your host, Doug Hoyes.
It is 8:30 at night on Thursday, April 2nd, 2020, as we record this. So big thanks to my guest for doing this on short notice. As those of you watching on YouTube will see, we are recording this on Zoom from our homes. So let's get started. Who are you and what do you do?
Oh, hey, Doug. It's good to be back. My name's Ben Rabidoux. I run a boutique research firm where we think a lot about macro risk to the Canadian economy and focus a lot on household credit trends and housing. And I got to correct you off the bat, Doug.
Yes.
I got to correct you off the bat. You give me a lot of props for getting some things right. I don't think anybody saw the coronavirus coming. You and I were talking about this beforehand, but we were kind of laughing about some of these people that have been, pessimistic for a long time and are now trying to do a victory lap on the coronavirus. That's not this guy. I did not see this coming whatsoever.
Well, and that's kind of the most amazing thing about this. So, because I listened to our last episode, episode number, whatever I just said, 266, which was released October 2019. I looked in my calendar. We recorded it on September 20th, 2019. So just over 6 months ago. And you did not predict COVID-19. So that's true. And you didn't predict that most of us would be in self-isolation. Neither did I, neither did anyone. But most of what you said was pretty much bang on. So you said 5-year mortgage rates, if you had, good credit, we're going to be pushing towards 2%. Well, I don't know if they're at 2% yet, but they're certainly lower than they've been. You said you were worried about deflation rather than inflation. So you pretty much got that one right. You were worried about real estate. You were worried about the debt service ratio, which was at a 30-year high at the time, and I think is going to be in more trouble now. So you were bang on about pretty much everything, and yet you, I, and everybody else missed the most obvious thing, which was this pandemic. So what does that tell you? How could you have had the direction so right and yet missed the most obvious thing that has put us in this situation?
Well, I think there's something more fundamental to think about here. And it's just that what we're dealing with are vulnerabilities, right? And the way that you need to look at the economy, and especially if you're someone that's trying to think of risk and what could come along and kind of blindside you, you're always looking for where are the pinch points, where are the vulnerabilities. You never know what's going to cause the crisis, but what you can do is look for, well, where is the buildup in any excesses? Where are the things that are way out of line with historical norms that could be problematic if you were to hit some sort of a rough patch in the economy or some sort of an exogenous shock. And so, I certainly didn't see COVID-19 coming, but at the same time, you could look at the imbalances of the household sector and you could say, you know what? Household debt service ratios at all-time highs when you've got interest rates near all-time lows. That's not a good combination. And we don't know what's going to cause the problem, what's going to be the thing that tips this. But when it comes along, it's going to be really problematic, right? And you could have said the same thing for corporate indebtedness in Canada, which has really risen a lot in the last number of years. So we're at, all-time highs in terms of corporate debt to GDP. So the imbalances were there, right? And so someone like me looks for those things, tries to flag them for clients. And, these are the 5 things we're watching that you could really come along and upend your life as an asset allocator or portfolio manager. And, we're trying to sort of keep on top of those things. So household indebtedness, housing, corporate indebtedness, population trends, the composition of economic growth and sustainability, those are all things that we've been flagging. And so, you knew the vulnerabilities were there. You didn't know what would bring those to the surface.
So we would have been here eventually anyways.
Well, I don't know. I mean, look, where we are right now is extreme. I'm sure you want to get into some of the numbers in terms of what's actually happening, but the numbers that we're going to be seeing in the next little while are just staggering, right? I mean, we're looking at, employment insurance claims in Canada that are probably going to run, 1.6 million in March, seasonally adjusted, which is an absolutely staggering number. I'd have to go back and look, but you're probably talking I mean, it's at least 8 times sort of a normal level, and it's probably going to push, before this is out, it's probably going to end up being closer to 20 times. So just an unprecedented level of unemployment, or the speed at which we've seen these job losses is unprecedented. I mean, that's going to be a huge issue. There's a very good chance that when we hit Q2 GDP, which we're not going to get, until, let's see, so that's the June quarter. So you're probably looking like August, you'll get that. But that quarter, we could end up printing something like a minus 20% annualized. Maybe even more. There's some estimates out there. I think they're maybe a little aggressive, but that you could push minus 30% annualized, which is just unbelievable, right? I mean, I've got you right here. I could pull up my data on GDP, but I think in the depths of the 08-09 recession, you were maybe a third of that at peak. So really a tremendous shock to the economy.
Well, so you're dialing the economy back 20%, let's say. So what is that? That puts us back
annualized
on an
right?
annualized basis. Okay.
Yeah. So you may end up with something like a 6% decline on the quarter, like quarter over quarter.
So that puts us with the economy the size it was 2 or 3 years ago, 4 or 5 years ago. Like what does that mean?
No. So if you're dropping 6%, so I mean, economic growth in real terms has been kind of 3%. More or less over the last few years. So if you're seeing a 6% growth, you'd give back 2 years of growth. Yeah.
And of course the stock market has given back a little more than that. So that kind of makes sense. Now, I believe you are a trained epidemiologist. Is that correct? You have a medical degree. Right. You understand all of these virus things. So
everybody's an epidemiologist.
Absolutely.
These days. And look on Twitter, everybody knows everything about
this. And we all have sore throats too. So can you tell me the day this will end then? Because I'm going to write that down because you got all the other predictions right. We might as well get this one nailed down right now too.
Yeah. No clue. I'm still inclined to think, well, first of all, not a trained epidemiologist, but I'm looking at the data, and to the extent that you can trust the data, which I know there's some big asterisks around that right now. We just don't know that we've had adequate testing, et cetera. But from what I'm seeing, I mean, I've been tracking even on Twitter, I've been posting it, but when you try to normalize things like deaths per million, right, and you normalize across countries and you pick a starting point, let's say the point at which they hit 1 death per million, you chart it out from there. Canada's tracking way under all these other countries. I mean, certainly we're not, South Korea and some of the countries that were really aggressive in terms of getting ahead of it. But we're not Italy, we're not Spain, we're certainly not the US, we're not the UK. So you could argue that we're in decent shape. Now, it's still early enough that we don't know how many people brought this home from abroad after the March break. So this thing could still and probably will get uglier before it gets better. But I also think that some of the social distancing policies we brought in, and especially some of the more aggressive measures from the government here in Ontario, are going to start moving the needle on this. I mean, they almost have to, right? I mean, even in Italy, you can see that they're starting to win now, right? I mean, the daily cases peaked around 6,500 daily, going back about a week and a half ago, and they're now 4,500, 4,000 a day. So you can see they've already started to bend this, and I mean, they were way behind the curve in terms of getting out in front of it. So I'm still optimistic. I really don't. I don't think this is. I'm still of the view that the virus itself will probably be a lot shorter than some of the kind of dire, cases dire estimates we're hearing right now. But the big question is the hit to the economy and how much and how long that lasts. And not only that, but how this might change consumer behavior. Because you could almost make the argument that one of the difficulties coming out of this recession is going to be that, first of all, you're going to lose a lot of businesses. We know that consumers are going to be awfully scared coming out of this. And the other thing is, even when we get on the other side of this, there's going to be a lot of scary headlines for months about possible second outbreaks. Are we going to have another, there's a lot of comparisons right now to the Spanish flu, 1918, 1919, and how you had an initial wave, and then the next year you had a second deadlier wave that came through and hit. And you're going to see those headlines, right? And so even when we're on the other side of this, it's going to be like it was in 2009, 2010, where every other article was like, well, we're through this, but this second dip down is coming, right? And so this is very important, because what it means is even when we're through this, you don't just go right back to boom time mentality. People don't just open up their wallet and go take out a HELOC and let's go take a cruise and let's go renovate the kitchen again. It's like, let's build a buffer so that we don't have to be terrified about how we're going to feed ourselves if something like this hits again. And let's start saving some money. So you actually could see a real fundamental shift in consumer behavior here, which is good from a long-term stability perspective, right? It's what we've needed, right? We've seen our savings rate in Canada has been consistently in the kind of 2 to 3% range for a few years now, which if you look stateside, and we like to here in Canada sort of be, on our high horse about those crazy Americans, but their savings rate at the household level is triple what ours is, right? And has been for years. So, we need to get to a place where households are saving for a rainy day. And I think that's coming. And so the problem that raises is right now in Canada, we've driven a lot of economic growth off household consumption. And so if you get into a sort of a new paradigm where consumers are now more inclined to save, that actually is a headwind to consumption, and it makes it very difficult to stimulate on the other side of this. And so that's one of the risks that everyone's trying to weigh through. The big question now is whether we've got a V shape in terms of the economic cycle, where you get we know for sure we've got a steep hit to the economy right now. What does it look like coming out of this? And that's where people are really torn. Some people are saying it's going to be a very rapid bounce out of this, given the size of the fiscal stimulus and the monetary stimulus, how cheap rates are. I'm not so sure. I'm more of the, if it's going to be a V, it's going to be steep down and then a long tail coming back out of it. I think that's more likely, because I don't think consumers go back to the boom time mentality immediately after this.
Yeah, and you and I were not alive during the Great Depression, so we don't remember what that was like. But what I am told is if you went through the Depression, that impacted your life for the rest of your life. So I understood what it was like, and so I was very frugal for the rest of my life. Nothing changed. Now, you made the comment that our economy was built, whatever, over economic over consumption. I would take it a step further and say it was built on debt. Would you agree with that or not?
No, I think that's a fair. Well, it's two sides of the same coin. I mean, how are you consuming things in Canada? How are we consuming things in Canada? Are we paying for them out of savings and out of our income, right? So it's actually, there are two sides of the same story, right? The consumption boom is a credit boom.
Right. And we have no savings. So clearly we're not paying for it out of our savings. So we must be paying for it out of debt. So if I've just gone through a period of 1, 2, 3 months of self-isolation, couldn't go out, couldn't do the normal things I did, and I realized that, oh my goodness, April 1st got here and I didn't have the cash to pay my rent. Mm-hmm. That's a pretty shocking thing. I talked to somebody last week who had been at the same job for 33 years and had never been laid off. Well, he's laid off now. Now, hopefully it's temporary and he'll be back. So will that change our mindset permanently so that when we get back, hopefully, I don't know, let's say it's June or July or late May or whenever it is, are we all going to do exactly what you just said? I'm going to build a buffer first. I'm going to try to, get my debt under control, build a buffer. Well, that means there's not going to be a whole lot of consumption for a long time. Is that a plausible scenario?
Yeah, I think that's exactly right. That's the risk coming out of this. I mean, and again, Doug, I'll get you the exact numbers. So I've got it all. I mean, I could pull it up right now on my screen here, but off the top of my head, I think in the last 5 years, we've levered economic growth somewhere in the ballpark of 80% off of household consumption and residential investment. Residential investment being building new houses, renovating houses, and then the buying and selling of houses, right? I mean, that's what we, the transaction expenses around housing is almost 2% of the economy. Just so imagine that, which is unprecedented, right? That we've never been that high, and we're way above where the U.S. peaked, right? So just the transaction expenses associated with buying and selling real estate, realtor fees, legal fees, et cetera, you're almost 2% of the economy just right there.
That's unbelievable.
Absolutely stunning. So way above any previous cyclical high, right? And so, I mean, that's just one tiny sliver of this bigger pie in terms of how housing and consumption drives the broader economy, but it's really indicative. I mean, this is a real phenomenon. And so, it's hard for me to see a scenario where this doesn't have some sort of effect on people. I mean, in the US, a lot of it's going to depend on how long this drags on too. In the US, we saw some really arguably structural changes in consumer behavior coming out of the financial crisis. We really weren't hit nearly as badly here in Canada. We had a 7-month blip, but then they dropped rates. HELOC credit absolutely boomed. Everybody went, oh, this is great. We can borrow off the line of credit. There was all these tax schemes put in place to encourage you to invest in your home, renovate. And it absolutely boomed the economy, right? Stateside, they really didn't have anything that put a floor under their economy nearly as quickly as we did. And so it was much more traumatic. And consequently, you saw things like household formations really tank, right? And so that's one of the things that never came back in the US after their recession is, people kept going, why in the world isn't there more pressure on housing? Because we're really not building very many houses compared to the size of the population and how much it's growing. And what everybody missed is that you went through this like structural change where people they were staying with parents longer. They were living in, you had bigger households for longer. And so the household formation rate just plunged. And that really hit the housing industry in the US. And so I'm not saying I think a lot of that is going to depend on how long this drags on for. But that's certainly a risk here. But I'll tell you what the bigger risk is in all of this, Doug, and one of the things that everybody's missing. So everybody understands that we're heading into a very steep recession. I mean, it's a given. We're going to have a huge hit to the economy. The numbers are going to be really scary for a while. We know we're going to have lots of job losses, et cetera. But we also know that rates are going to be low, and so there's going to be some offset there. There's going to be tremendous fiscal stimulus. One of the things that people are missing, though, is if you look at population growth in Canada right now, so last quarter, again, Doug, I'm going off the top of my head, so don't hold me to this number, but it was over 600,000 nominal population growth year over year in Canada. So we added 600,000 people to population. Now, what's really interesting is when you sort of pull apart the composition of that growth, natural increase is extremely low, right? So Canadians that are already here making new people that are already here, extremely low, right? So of course we know a lot that most of it is via immigration. But within that, you've got a subsection that's known as non-permanent residents. And that's a very important point. So non-permanent residents are primarily work permit holders and foreign students. And the work permit holder component is extremely pro-cyclical. And what that means is that program is designed to grow when the labor market is extremely tight. It's designed to bring in workers to meet the demands of the labor market. But on the flip side, when the economy turns, it's designed to shrink. And so it's a rotating door. And so what you see is when we go through recessions in Canada, that non-permanent resident cohort always sees outflows. And the most significant were in the late 80s and early 90s when the non-permanent resident cohort was cut in half over a number of years. So why this matters in Canada is if you look at non-permanent residents as a share of the total, it's about 3.6%. So 3.6% of the entire Canadian population is this non-permanent resident cohort. That is unprecedented. In the last year, that's grown by 200,000. So that's accounted for over a third of the headline nominal population growth. Okay, I hope I'm not, are you still tracking with me here, Doug?
I'm with you.
Okay, so this is where it gets very important. So you now have 3.6% of all Canadians, all people in this country right now that are non-permanent residents here either through student visas or more importantly through work permit holders. Now my question to you is, what will the demand be for work permit holders when the unemployment rate hits 10, 12, 14%, which is coming?
I'm guessing zero.
Zero. So what happens to that cohort? It shrinks massively. And so what you end up with is you go from headline population growth that's 600,000 because you have a 200,000 tailwind, right, from all these non-permanent residents coming. All of a sudden, those non-permanent residents flip negative. And so now you go from something like 600,000 to 200,000 in just a few quarters. And nobody's expecting that. right? See, because what happened was when we had 400,000, 500,000, 600,000 nominal population growth, you literally can't build enough housing to meet that need. It was actually a policy failure in Canada that we had such aggressive policies to bring people here, but not necessarily a plan to how to house them. And so what we ended up seeing was this tremendously tight rental market, right? And so now that's flipped in reverse, right? And so you're going to see now that the level of construction and what's coming in the pipeline is actually going to be way above what we're going to need for a period of time. And then you layer on top of that the fact that the rental market was already softening in places like Toronto. I've written about this quite a bit, but the condo rental market has actually been softening for several quarters in Toronto. Now throw in the fact that you've got thousands of Airbnb rentals that are going to be entering the long-term rental pool. One, because you've got new regulations out of Toronto that are forcing them to, but more importantly, because Airbnb's been decimated, right? I mean, the bookings are down 95%. So those are going to be entering long-term rental pools. So it's a setup. It's one of the big underappreciated risks right now, because if you look at GDP per capita in Canada in real terms, it's already negative, right? And was before the recession. This is very important. So all of the headline GDP growth is a function of this massive population boom that we've seen, and that's ended. I'm telling you right now, people are going to be surprised at how quickly population growth slows.
So this sounds big, like what you're talking about here, if my brain is following you. So for the last X number of years, we've been building and haven't been able to create enough housing. I mean, you've been to my office at Yonge and King in Toronto, and Toronto is just condos. And those condos have either been purchased by investors who've been renting them out, or as you say, renting them out as Airbnbs. And I have no idea what the number of Airbnbs is in Toronto. What is it, like 20,000 or something? Like, it's probably a pretty massive number. So Airbnbs are now blown away. There's no way I'm staying in some place where some guy might have been quarantined for 14 days, right? And all these people who were coming to Canada are now leaving Canada. So does that not totally crash the real estate market in a place like Toronto or Vancouver?
Well, it's a risk. So I don't know, and we're not going to know for a while, right? What I would say is at the very minimum, you've eliminated a major tailwind to the housing market, right? See, the issue now is the real estate market is going to be completely frozen for a number of months. I mean, no one wants to buy right now, but more importantly, no one wants to sell. Who wants to have open houses right now?
Yeah, I can't go to an open house. That's not social distancing.
No, and so, there's no clearing mechanism for the market. No one wants to buy, no one wants to sell. The market's just going to freeze. So transactions will be way down, but listings will be way down. And you're just going to sit there in limbo for a while, right? And more importantly, everyone's worried about the effect for banks and some of these other lenders. It's not going to be a story for a year, right? The issue is, let's say that you're a lender and you want to go ahead and foreclose on a property because the person's delinquent. Good luck getting in front of a judge.
Well, the courts are closed at the moment.
The courts are closed. And by the time they open, do you know how backlogged they're going to be?
Yeah,
you're going to be a year before you can get that person out. So we have no idea how this is going to play out. But like I said, Doug, I mean, I don't know how this is going to play out. I mean, I would say I have a very strong conviction that the rental market's going to get hit first. And then it's probably, certainly there's going to be downside to house prices. The extent of that, I don't know. I mean, the good thing that Toronto, and to a lesser extent Vancouver, had going into this is that the market was extremely well balanced. In fact, it was tilting very strongly towards a seller's market. And that matters a lot because it does buy you time. These markets don't just turn on a dime. What you generally see is they got to build up inventory. You need an imbalance. Sellers will fight and resist that, and then eventually they'll sort of capitulate. And that doesn't happen overnight. But it happens much quicker if you're starting at a point where the market is already weak. And we weren't there in Toronto. It's starting from a very strong point. So, you're talking about a story that's going to play out more in the fall than over the next few months, right? If at all. But certainly none of this is good for housing. There's just no way around it. This is all terrible for housing.
Well, unless you're someone who wants to rent an apartment 6 months from now.
or even now.
Or even now.
I mean,
Yeah.
already rents are trending down. I mean, they're down significantly in Toronto already.
And
Right?
so can you foresee a scenario where rents go down 10%?
Yes.
What about 20%?
It's hard. Rents are sticky. Rents. You don't always see. I mean, 20%, probably not, but maybe. There's a lot of. So the one thing that we know, or that we think we know, going into 2020, if you listen to some of the really smart people in the condo space, and I would turn to folks like the people at Urbanation that track condo completions, and their estimates put 2020 and 2021 at extremely high levels of completions. Now, of course, big question. I mean, you're not going to have a lot of completions in the near term because no one's at those construction sites. But eventually, when we get back to this, you will have a lot of inventory coming online. And a lot of those condos, about half of the condos that are completed are entering the long-term rental pool right now. So it's a lot of rental supply. You also have, I mean, I've put this out on Twitter a lot, but if you look at the level of purpose-built apartment construction in Canada, it's extremely high. I mean, everyone's been talking about we haven't built purpose-built rentals. Well, we're building them now, and in quite a bit of size. I mean, there's about 70,000 units under construction right now across Canada. And so all of that's coming online at a time where the population growth, I think people are going to be surprised at how weak that comes in the next few quarters. I mean, it's not going to happen tomorrow, but you're talking about Q2, Q3, that those numbers are going to start trickling in. So could you see 20% down? I mean, well, some of the metros in Alberta saw 30% drop in headline in spot rents. But that's a bit exceptional, right? I mean, what's happened in Alberta is a bit, I mean, it's been a bit of carnage out there. I would not say 20% as a base case, but getting to 10%, absolutely. Absolutely.
So the clients that I've been meeting with, and, you know, my colleague Scott Terrio, who you know very well, have been meeting with over the last year or two, who were subject to renovictions where the landlord, well, you know, I'm moving my mother in, so you got to go. And then their mother lives there for one day. And then next thing you know, the rents are 30% higher because the guy's been living there for 5 years. We're not going to be seeing much of that, are we?
Well, you shouldn't be seeing that right now anyways. I mean, there's the new regulations that came in last year around that.
Well, there's regulations, and then there's what happens in real life, right?
Like, no, I disagree with you. This is one where no landlord wants to get hauled before the tenancy board, the landlord tenants. Mm-hmm. What's it called? The LTB.
I know what you're talking about.
You know who would be good to have on is Rachel Brube, mm-hmm. Landlord Rescue.
Yes, well,
I mean, one of the big things is, you know, there's now the incentive or the impetus to show that the renovation happened in good faith is now on the part of the landlord, which means that if you think you've been renovicted for exactly the reason that you said, you can appeal it to that board, and the onus is on the landlord to show that no, actually we did move in here and we stayed here for several years, and if not, it's a big fine. I mean, you're talking like $25,000.
Yeah, so, and I guess
no landlord wants to go before that board because it does tilt very much in favor of the tenants.
Yeah, and I'm not talking about the big corporation. I'm talking about Joe who rented out a condo or rented out his basement or whatever. And if somebody's been living in that condo for 5 years and they're paying $1,500 a month rent, where the market rates are now $2,500, you know, pushing someone out and, you know, risking a fine. Well, the guy I've pushed out is a working person. He probably doesn't know about all these tenant boards and all the rest of it. I guess my point is there's going to be no incentive to do that anyways. If I'm a landlord, I may want to be really nice to my tenants and make sure they stick around, because if rents are going to fall 10% or potentially 20%, a good tenant is going to become a pretty valuable commodity, I would think.
Yeah. Yeah, so 10 or 20%, those are your words, not mine. But definitely downward pressure in rents. I don't disagree. I think you're right. I think, we're shifting towards a market that's going to be a lot more favorable to renters.
Yeah, and the real estate market, you know, prices going down is bad if you own, but it's good if you're a renter. And I guess it's good if you haven't purchased yet. So it's two sides of the same coin. So if you were wanting to get into the real estate market, let's say you're a renter now, I assume you are not advising someone to rush out and do something today. Well, like you said, the market's frozen anyway. It's not like you could buy something tomorrow if you wanted to. But it is likely that there will be better deals in the future than there are today. Is that an accurate statement?
Yeah, I would think so. I mean, it's hard. Again, so much of this is so unprecedented just in terms of the speed at which this is hit and how little we know about how this is going to play out. I mean, most recessions, at least, I mean, you sort of know that it's usually, you've overbuilt capacity, and so then manufacturers have to shut down. And and you sort of know the playbook for how those play out. This is very different. I mean, we've never seen this. So my inclination would be, yeah, that's probably right. We're not going to know for a few months until things sort of thaw out. And we're not going to know until we know sort of the depth of the job losses and how much the government fiscal supports will help. But yeah, I've got to think that this is going to get worse before it gets better.
Yeah. So how can it not? You're taking a significant portion of the Airbnb out of the market. You're taking a bunch of people out of the market. You already, documented, we're talking potentially hundreds of thousands of people. And, we've also got you mentioned the word structural change. Well, for the last week or two, and again, we're recording this on April 2nd, 2020, there's been a lot of people working like I am right now in my basement. I mean, you've been self-isolating for a few years, I believe, but the rest of us, this is a new thing. And there's going to be a lot of people that are going, you know what? I don't have to live in North York so I can drive into Toronto or take the TTC, the subway into Toronto. I could be living in Barrie. I could be living in, someplace far away. Does that not also then have a significant impact on the real estate market? Again, we don't know, but there's another, tailwind or headwind or however you refer to it.
Yeah, that's very possible. I mean, you could see that the suburbs are a big winner here, that lower density people are willing to try working from home. You may well see that. I don't disagree. Now, I think some of the narrative out there around that is probably a little bit maybe overstated. I think that my thinking is after a few weeks of trying to work from home, especially if you get kids running around, that people are going to really long for the office.
Yeah, that's right.
So I don't know that that's going to end up being a permanent shift.
It's going to be so great in June.
There's going to be some changes that come out of this. And I don't disagree with you. I think that is going to be one of them, that you will find more businesses figure out that, we can actually make this work remotely. So I think the premise is right. The magnitude is somewhat up in the air. But the other one that's interesting is, Amazon's going to come out of this for sure a big winner, right? Amazon is still in the early days of their penetration into Canada. Right. And you can see this, you look at same store sales at Canadian Tire is one example. You look anywhere that skews more towards the discretionary spending, like the, hockey sticks and camping gear and fishing and, garden and reno type stuff, right? Very discretionary stuff that you don't need, but that you buy it because you have a bit of extra money, right? It's been shocking how well their store sales have held up, even as their U.S. counterparts. The brick and mortar has just been decimated, right? Retail apocalypse. Mm-hmm. And we really haven't seen that among some of the bigger stores in Canada yet. But, I use my father-in-law as an example because I kind of give him a hard time. The man, I love him, but he is so tech illiterate that he cannot take a picture on his phone without getting his thumb in the way. Right. And it doesn't matter how many times you show the guy, he just can't do it. And yet this is a guy that just recently has been like, hey, you know what? Actually, Amazon, this actually kind of is neat. And so, is he always going to do that even when the stores reopen? No, not at the level he is currently. But there's going to be, I think there will be some things where he goes, you know what? Actually, that is pretty handy. I'll just reorder it off Amazon. Maybe I don't have to drive across town to Canadian Tire or Home Depot or whatever, right? And it's just going to expedite the penetration of Amazon into Canada, and it's a big issue for brick and mortar retailers in Canada for sure. I think that's one of the things that, in addition to what we talked about just a big pinch in discretionary spending and how that's going to affect consumption. So, some of the big iconic Canadian retailers, I would not be surprised if a year from now, 18 months from now, they're in real trouble.
Yeah, unless they can figure out how online works. But I guess you're right. Amazon's
man. Have you tried ordering something from? I hate to pick on Canadian Tire, but have you tried ordering something online? Have you even tried to find something online at Canadian Tire? It's an archaic system. It's horrible.
Yeah, and it's not as simple as it sounds to just put stuff on the computer and have a distribution system and all the rest of it. So,
Right. Well, that's the other issue. Yeah, 100%. Amazon's miles ahead of them.
so I got two more questions for you. So a few hours ago on Twitter, I put your question out there. Hey, what do you want to ask Ben? Because he's coming on the show, and a bunch of people wanted to know about, the non-big bank mortgage lenders. So, Jamie asked, which lenders will this crisis impact first? Shadow lenders like Home Capital or Equitable Group? What is the importance of shadow lenders in the mortgage-backed securities pool? I don't think we're going to get into mortgage-backed securities pool here today, but, Paul wanted to know, Paul said, ask him how long till this document is down to 10 pages from 20. And he linked to a document that had a list of alternative, mortgage lenders. So on our last podcast, you correctly said that, the outlook for these, private lenders, secondary lenders is a little sketchy. And I would assume going forward, it's kind of really sketchy because, mom and pop who didn't want to put their money in the bank earning 0.5% heard about these fantastic deals where they can earn a guaranteed 10%, earning, money on second mortgages that are completely risk-free and never go down. I assume those are the people who are going to get crushed. And I'm not talking about, we're not going to mention the firm we talked about on the last podcast, those guys who wanted to sue you and all the rest of it. That was a great podcast. People can go back and listen to that. But I'm talking about just the average guy who invested in mortgages. Are they not at risk of getting wiped out here?
Yeah, of course they are. I mean, big time. But you got to draw a line between the true private space and more the institutional B-side lending. So some of the small 10, 20, $30 million mix that have popped up, I mean, there have been hundreds, if not thousands across the country, right, in the last number of years. And these are people that have never seen a cycle. Very different than your institutional B-side lenders like the Home Capital and the Equitable. So you think of these guys as like the first domino to fall. I had Terrio on a conference call with my clients, and along with us was Ron Butler, who is just the guy is unbelievable in terms of his connection, his insight in the mortgage industry. He's sort of a stalwart in the industry, and he is so insightful on this stuff. And so I put it to him, and I said, like, well, how do you see the private mortgage landscape over the next number of years? And he said it just so clearly. He's like, there are probably 500 MICs right now that are walking the green mile. They are dead businesses walking. And they may not realize it yet, and people may not realize it yet, but they're dead. And he's totally right. He's 100% right. These MICs that have lent out in second position, I mean, just think about it. I mean, it's such a crazy scenario. These guys are second position behind these banks. What if all of the banks just announced with regards to mortgages?
You don't have to make your payment next month.
Right. And so what does that do to the equity position of the second mortgage holder?
Not good.
It just eats into their position, right? And then these mortgage holders, let's say that you actually want to go ahead and foreclose. Let's say that one of these banks wants to foreclose, or God forbid, a first private lender with very expensive terms wants to foreclose, right? Well, you're going to be a year now getting through the court system, which means that as that's happening, they're accruing interest and eating the equity position of the second mortgage holder.
At the same time, the price is going down potentially.
You don't need prices to go down. The fact that the courts are now done for a year and that you've got first mortgage holders in front of you that are going to be accruing and eating into your equity position, you're done, man. You're done. And not only that, but you've got now a situation where investors are starting to ask for their money back. They're wanting redemptions. Everybody's nervous. Banks, they don't want to, these private guys don't want to lend because they're concerned about property valuation and they're concerned about getting their money back down the road. Who's going to take them out and get them paid out on this 1-year mortgage? The whole thing is broken right now. And Butler's right. Now, listen, there's guys in that space, and I know that people want to talk specifically about the publicly traded Home Cap and Equitable. I'm not going to go there right now because that's for my clients. But I'm just telling you, there's some older, more established mortgage investment corporations that have seen cycles. I know the people that are running them. I think very highly of them, and they're going to be fine. They're going to navigate this fine. It's the ones that have popped up in the last few years that have skewed heavily towards these second mortgages because of the yield and have marketed them towards these yield-hungry investors. They're going to get decimated. This is it for them, man.
They're done.
They're done.
Yep.
Go
So
forward, get 'em.
I don't think we have to read between the lines on what you're saying then. So that's good. There you go. They are done. It's over. And look, the math is pretty simple, right? If I had a 20% down and the price, erodes by 20%, of course, it doesn't have to erode by 20% because of all the costs and everything.
No,
then
it's way worse than that. No, let me stop you there. The math is way worse than that, Doug. So let's take the insurers like CMHC and Genworth right now. They report publicly their severity ratios, which is basically the dollar loss that they take on properties that they have to repossess and resell. It's consistently in the mid-20s. Now, find anywhere in Canada where prices are down that much, right? See, what people don't realize is, when you have to kick someone out of their house, you don't take back a pristine house, right? If they're not paying you, they're also not doing upkeep. They maybe haven't paid their back taxes. Maybe they're not real happy about being kicked out. And so on the way out, they trash a bunch of stuff. But even before you get to the point where you kick them out, you got to go through the courts. That's costly, right? You've got to, you've got interest payments that are being missed. All this stuff accrues, right? And so you're lucky in a flat market where you've got a fair bit of liquidity. You're lucky if you can get out of this, with your fees at 10 to 15% and have that house marketable again, right? And that's in a good market. The moment that you see liquidity evaporate, which is happening right now, and you see the courts get backlogged, and so your holding times blow out, dude, that's 30, 40%, right? So your cost of getting in and out, if you lent to somebody at 80% loan to value,
you're done.
And the liquidity goes to, you're not getting out whole right now.
Yeah, it's as simple as that.
Chance.
Well, so on that positive note, final question, which is really, I think, the same question you just answered, but I'll ask it in a different way because I want to use the word HELOC at some point in this thing, because if I put the word HELOC in the title, then the algorithm on YouTube makes everyone go see it, right? So I'm guessing that if I am a bank and I am lending on HELOCs, and we're using jargon here. We talked about MIX, which is a mortgage investment corporation for the people who don't know what we're talking about. A HELOC is, of course, a home equity line of credit, which is kind of just like a mortgage. It's secured by your house, but it's a line of credit. It goes up and down, up and down. And so very flexible. I can, borrow whenever I want. I assume at some point in the very near future, banks are going to put a cap on that and say, oh, that $300,000 HELOC you qualified for, well, now it's $200,000. Now the interest rate is higher. Now there's, you got to flip it into a regular loan or whatever. But my question then is, what do you see HELOC wise, both from the point of view of the lenders and the point of view of people attempting to borrow? And you've been talking a lot about this on Twitter recently as well. I don't know what the term is, utilization or something. What's the concept there when it comes to HELOCs?
I'll frame it for your listeners or your viewers. So again, getting back to identifying risks, but not knowing necessarily what's going to bring them to the forefront. When we look at drawn HELOC balances, I think that's the term you were looking at.
Drawn HELOC balances, yes.
Yeah, so the HELOC balances that are actually, so not what's available, what's actually been drawn, outstanding debt, and you normalize it to GDP just so that you can kind of compare it across countries. The US peaked at about 4.5% of GDP in terms of drawn HELOC balances. And of course, at the time, that was what was really toxic in the US, were these cash out refis, HELOCs, those are things that really blew up. In Canada, I mean, it's a different lending environment, so I don't want to draw straight line parallels, but in Canada, we're over 13%. And the US, because they've gone through a deleveraging cycle, they're actually now back under 2% of GDP. So drawn HELOC balances in the US today, about 1.8% of GDP equivalent. In Canada, it's over 13%. Right? And so now when you think about, okay, well, what does that mean, right? So that's been one of those things that's gone a long way to help sort of boost consumption. And one of the great appeals of these home equity lines of credit is that they're the most popular structure is interest only, readvanceable, which means that you're only paying interest on what you borrow and you're not amortizing it. And so your payments are almost nothing. But the risk has always been that lender behavior will change, because these HELOCs are fully callable, which means that literally if the bank wanted it, oh, thanks, my wife's bringing me a tea. Look at this. Living the dream here.
Cheers.
Cheers, buddy. So if the bank wanted to, they can call it tomorrow. I mean, this is legally. They could call you up. Hey, that $200,000, we would like it back now, please. Right now, in practice, have they ever done that? No. Will they do that on scale? God forbid. I don't think that's likely, but it's a risk. But much more likely is that they force amortization. Right? So when they get nervous, well, and actually even before that happens, Doug, what you mentioned will happen and is happening right now, which is you thought you had $200,000 undrawn. Guess what? That's canceled now, right? That line is gone. That's absolutely going to happen. You will not be able to get a HELOC from a Canadian institution in a month, right? I really believe that. If things don't,
say that again. You will not be able to get a HELOC from a Canadian institution in a month.
I'm serious, man. I'm serious.
So you're talking May 2020. You think it will be very difficult?
I think that the extent to which lenders are tightening right now in response to this, and the extent to which we're seeing dramatic liquidity constraints and pressure in the system, that's the first thing on the chopping block. You thought you had $200,000 in room on your line of credit? No, you don't. No, you don't. Bank's just going to axe that, right? Because that's the other thing. Right, because one of the risks, OSFI's been talking about this for a while, and all of a sudden it came to fruition. The big risk to the banks in a lot of this is that you've got these undrawn balances that businesses have sitting there, right? Undrawn lines of credit, which they'll tap into in a crisis, right? So what do you think every business that was about to be shut down by the government did 2 weeks ago? Yep. They all went in and drained their lines of credit, right? Yep. And so any line of credit that the bank can go out and cut, which is all of the consumer lines of credit, they're going to do that.
Do you have any idea how big
they'll do that?
Yeah. Do you have any idea how big the undrawn lines of HELOCs are?
I don't. I mean, here's what we know is that OSFI was already leaning, OSFI being the bank regulator, was already leaning on the banks to curb their growth, right? Because domestic HELOC growth in Canada has already been plunging for about a year and a half. Right, it was kind of 7-8%. It's down to just a couple percent now.
Because the banks have been tightening?
Well, not voluntarily, right? This has been OSFI leaning on them because OSFI's written extensively about their concerns around lines of credit, right? And so, there was already, I believe, a push to have more of these products amortizing, right? Or to have to just change the structure so that it was more of like an interest-only period, and then it flipped to amortizing. This idea that you just have this perpetual balance that you never touch has never sat well with the regulators, right? So my point is, if you think through what the banks are going to do, number one, they're going to cut those limits. I mean, you're going to start hearing about that like in a couple of weeks, right? That's just going to happen. And then next, you're going to see, I think, you may start seeing some of them are going to be forced amortized. Now, if you think through what that does to discretionary disposable income, let's just say, right? So if you had, if you were used to paying $100 on your HELOC and all of a sudden you have to amortize it and it's $250 a month, right? That's not nothing, right?
Yeah.
And so that's been one of the risks as well, is that, the lending environment's going to change. I mean, the lending environment is absolutely not going to be the same coming out of the other side. Ron talked about this quite a bit, is that, the way we've been used to financing rental houses, it's just not going to be the same on the backside of this, right? I mean, banks are going to tighten dramatically.
Well, I talked to a guy in the last 2 or 3 days who owned a house, and the house went up in value. So he thought, hey, this is pretty cool. I'm going to get a HELOC on my house, and I'm going to use that money to buy another house. So that
hey, I'm going to stop you right there. Guess what? A major bank in Canada just today came out and said, we're no longer going to allow that. We want to see saved capital as a down payment on an investment property. Done, Doug. I'm telling you, that's one of the things that's going to be done on the other side of
this. Well, and this particular guy was
not happening.
Yeah, he was in the middle of a renovation on the second house. So everything's frozen now. So whatever he was able to, I mean, he's now going to have to sell the property. He's got really no choice, but of course you can't sell the property because, as you've already documented, everything's all frozen. So this is a huge mess. So if I have an undrawn HELOC right now, I might as well just assume I don't have a HELOC, Is
Well,
that
I
a
think
fair
if
assumption?
it's still there, I mean, if it's still there and you can grab it now.
Yeah,
Right?
because
If
next
you
month
want
I may
that
not
money,
be able
if
to.
you need that money in the next few months, I would grab it now, because I think the way that things are going, and look, I mean, things can turn around quickly, but I think that the way that it's going, you're going to see credit tighten quite significantly, these banks, and it's going to start on those lines of credit. It's going to start with reducing the line that's available.
Wow. Well, so on that
You're
happy
already
note,
seeing it, man. You're already seeing it, right?
Oh, I
I'm
know.
already hearing about it.
Yep.
It's only getting worse, not getting better right now. So
Yep.
you look at what this is going to look like 2, 3, 5 weeks from now. It's not better.
Yep. Yeah. I mean, I am not seeing everything yet because everyone's still in lockdown mode, do nothing mode. You know, it's like, okay, how do I pay the rent? How do I make my mortgage payment? That sort of thing. But yes, 2, 3, 4, 5 weeks from now, as things gradually, you know, we gradually all come up, that's when all this stuff will come to the forefront. And what you're saying is the light at the end of the tunnel is a train coming towards us. Pretty much as simple as that.
Maybe I don't know, man. If I was an epidemiologist, I knew how this was going to play out, I'd have a better view of this. But none of us knows. That's the scary part right now. And so much of how this plays out is going to depend on the course of this.
But even the best case scenario, and I'm an optimist, I think that if the virus has a 14-day gestation period and you lock everybody up for 14 days, then that goes a long way to knocking the stuffing out of it. And I am also not an epidemiologist, so I could be completely wrong on that. But by the end of April, we will have been in lockdown mode for weeks and weeks and weeks. And I get it. People are still going out and doing stuff, but at a far less rate than they were. So I've got to believe that has a big impact on the cases reducing. And like you, we all get up in the morning and we go to the website, and we run the stats to see what the caseload changed. And the number I look at more than anything is the number of deaths as opposed to the number of cases, because if we increase testing, you're going to see more cases and all the rest of that. But even best case scenario, so we get this thing under control, and in a month and a half, we're gradually able to let people go back to work, start with the younger people, that sort of thing. It's not going to change. It's not going to have the banks all of a sudden saying everyone gets a HELOC. It's going to be the exact opposite. So there is no quick fix here.
I think that's right. I think that regardless the other side of this, there's going to be a serious rethink from risk managers at the banks around their thought process on underwriting, especially on investment properties and lines of credit. I think that's a given. Everything else is up in the air. I mean, who knows? They could announce an actual vaccine or some effective treatment tomorrow, and the stock market rips 20%, and we're back to the. I mean, who knows? Who knows how this plays out? But if you just think through what a baseline looks like, it's probably that we're in some form of a muddle through for a couple months here, and then you come out of it, and then there's sort of this nagging fear for a number of months around, okay, is it coming back? We're going to have a second wave, and it just kind of drags on the economy through most of 2020. I mean, I think that's probably a reasonable base case right now.
Yeah, and even if they do have a treatment for it, well, it's kind of hard to make 8 billion doses right away and give it to all of us. And I mean, we've all had a common cold before. You get over the cold, but you're not back to running marathons the next day. There's a period of recovery. So I guess best case scenario, that's what we're looking at. So, well, Ben, I really appreciate you taking the time to do this. Do you have any final thoughts, anything that you can leave people with other than stay in your house for a month?
Well, I guess I would say I've been posting some charts on Twitter. Maybe just leave everybody with a bit of encouragement. I do think the numbers, I know there's a lot of questions around how valid the testing is, but the numbers in Canada right now do look like we're tracking on a much better trajectory than a lot of other countries. And let's just hope that stays the way that it is currently. And kudos to, I think, not to get political, but I do think that the leaders at a number of levels are doing a good job, especially the provinces across the country, at trying to get in front of this thing. And I think it's starting to show. So, all of your listeners, stay well and be smart, and let's just friggin' power through and get this thing behind us.
I think that's an excellent way to end it. Ben, thanks very much.
My pleasure, Doug. Take care.
Thank you. Let's hope that we can talk again in a few months, and it's much better news. So there you go. That's our show for today. Thank you for listening. Until next week, I'm Doug Hoyes. That was Debt Free in about 54 minutes.
Sorry, man. I always blow out your timeline on this thing.
Well, I almost started on my list of questions I had for you too, but well, next time.
Sorry, man. I talked too much.
No, I think that was great, and you had some definite opinions there. That's for sure. So
well, listen, yeah, as I was saying it, I was thinking, you know what, this may not age well.
or it may be brilliant.
Opinions at this point may not age well. We'll see.
Well, if it doesn't, I'll delete it from the internet and no one will ever know. So